Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're comparing LandBridge, LB, and Texas Pacific Land, TPL. And these are two entities that control, absolutely irreplicable assets in the Delaware and Midland basins. The central conflict here is it's really profound. You've got TPL, the mineral giant, and on the other side, LB, the surface baron.
Okay, mineral giant versus surface baron. I like that.
Exactly. And they're both using their Permian land to achieve just ultra-high profitability. Look at LB. They're reporting an incredible 88% adjusted EBITDA margin in the third quarter of 2025. However, the choice between them, it really rests entirely on investors' preference. Do you want TPL's direct commodity upside from its vast 882,000 surface acres, or do you prefer LB's, frankly, structurally superior, highly stable 91% fixed-fee revenue and its very deliberate strategic bet on capturing the AI infrastructure boom, and, this is crucial, the growing scarcity of pore space?
That immediately sets up a really nuanced contrast, doesn't it? It's not just about who has more acres in their portfolio. It's about whose business model is actually better structured for the volatility of today and for the industrial growth of tomorrow. So let's unpack those core models first, that foundational split you mentioned, mineral versus surface rights.
When we look at TPL, we're looking at a historical anomaly, right? A company that traces its lineage back to a 19th century land trust. So explain why TPL acts almost perfectly as a pure call option on energy.
It really is all about legacy and legal rights. The way TPL's assets were parceled out, back in the trust era, it meant they retained these massive mineral rights under vast swaths of land all across the Permian. So what this means is that their revenue stream is inherently and directly linked to the price and volume of the hydrocarbons that get extracted.
Right. So when an E&P company drills on their land, TPL gets a cut. Precisely. They get a cut, the ONG royalties. And just to put a number on that, year-to-date 2025, that amounted to just over $314 million in revenue. It's a massive chunk of their overall income.
Wow.
Yeah. So if the price of WTI crude surges, TPL's profitability just surges right along with it, and they don't have to put a single shovel in the ground. They are, for all intents and purposes, a passive but highly profitable direct commodity exposure vehicle.
And I guess while that mineral exposure gives you incredible torque, during an upcycle, the flip side is pretty obvious. You're completely at the mercy of the cyclical nature of oil and gas. And it seems like even TPL's efforts to diversify into things like water services, which are fee-based, are still kind of indirectly tied to the whims of the drilling rig count.
That's the critical subtlety that I think a lot of people miss about TPL's seemingly stable water business. So TPL has its Water Services and Operations Division, the WSO. This division is vital, don't get me wrong. It generates revenues from produced water royalties and water sales.
And that's all contractual fee-based income.
It is. Contractual and fee-based, which, year-to-date 2025, totaled roughly $90.7 million and $108.9 million, respectively. So you see that word fee and you immediately think stable.
But the volume of that water revenue is completely dependent on how many wells the operators are actively drilling and fracking at any given time.
Exactly right. If E&P companies decide to slow down drilling because they're, bearish on future oil prices, even if the fee TPL charges per barrel of water stays high, the total volume of water they handle decreases. And so their WSO revenue shrinks. And the latest data, it just perfectly illustrates this indirect volatility. So TPL managed to negotiate a really healthy 14.3% increase in water sales pricing in Q3 2025 compared to the same quarter in 2024.
Okay, that's good management.
It is good management, but at the same time, their actual water sales volumes decreased by 7.5% year-to-date 2025 versus the prior year.
So there it is.
That's the tell. That volume shrinkage, despite a price hike, it just demonstrates that inherent indirect link TPL has to commodity price sentiment and drilling activity. They can raise prices all they want, but if their customers stop drilling, the revenue volume just vanishes.
Okay, so TPL is fundamentally energy correlated. Yeah. Both directly through the mineral royalties and then indirectly through the water volumes tied to drilling activity. Now let's turn the lens to LandBridge, the surface baron. You call them a toll road operator. Explain in detail how LB systematically decouples itself from that oil price volatility that TPL just can't seem to escape.
Well, LB made a very conscious decision to be an infrastructure company first and a landowner second. They're monetizing the surface and the logistics required to operate an industrial basin rather than, relying on the extraction itself.
Think of it this way. Everyone operating in the Permian, I don't care if they're drilling for oil, laying a pipeline, building power lines, or disposing of water, they all need LB's roads, their rights-of-way, and their easements.
And for that access, they pay a fee. They pay a fixed fee, almost like paying a toll every time they cross a bridge.
So the revenue is derived from the necessity of access, not the value of the resource that's being extracted. I mean, that sounds like a structurally superior business model for stability.
It is, and the metrics just completely confirm it. LB has engineered its business so that a remarkable 91% of their year-to-date 2025 revenue is fixed fee.
91%.
91%. That is the kind of revenue stability you'd expect from, like, a utility company or a top-tier infrastructure fund, not a company operating in the middle of the volatile Permian Basin. This insulation allows them to project their earnings with far greater certainty than TPL ever could.
And that level of fixed fee stability must be the engine behind that insane profitability metric you mentioned at the top. The 88% adjusted EBITDA margin in Q3 2025. I mean, how is that even possible?
It's possible because of their incredibly low capital expenditure requirement. They're asset light on the extraction side of things. When 91% of your revenue comes from simply granting access and rights of way, your operating costs are, well, they're minimal.
You're just managing contracts, not drilling wells.
Right. You're maintaining roads and managing contracts, not drilling expensive wells or operating complex processing facilities. This operational leverage is what generates those ultra-high margins. You compare that to a traditional E&P company that might struggle to hit, 40% margins, even in the best of times. LB's model inherently translates almost every single dollar of surface access revenue straight into profit.
So what makes up the bulk of that income? Where do those surface fees primarily come from?
The largest share, we're talking 67% of their year-to-date 2025 revenue, comes from what they call surface use royalties and revenues. This bucket covers all the critical logistics: fees for using the roads, fees for pipeline and gathering system easements, fees for electric transmission lines, and critically, fees for setting up the drilling location pads themselves. They're literally charging for every single point of infrastructure built across their land.
Can we look at the specific growth drivers here? I mean, if they aren't relying on a big oil price spike, what is driving that phenomenal $8.5 million increase in surface use royalties they saw in Q3 2025?
That growth really demonstrates the resilience of their model. The primary driver of that $8.5 million increase was not a commodity spike at all. It was rather the increased produced water handling, including the associated skim oil royalties.
Water again, but in a different way.
A totally different way. This revenue stream jumped by $8.4 million, and it was fueled by a substantial volume growth of approximately 726,000 barrels per day, imbued of produced water. And this volume surge, it came from two places: their successful 2024 acquisitions being integrated and organic expansion from their existing partners.
So LB is capitalizing on the necessity of water disposal. That need grows with every barrel of oil drilled, regardless of what that oil is selling for. They're basically profiting from the logistics headache of the Permian.
That's a perfect way to put it.
Okay, that shifts our entire focus from the fluctuating price of oil to the structural, non-negotiable logistics of operating in the basin. And that leads us directly to the quality of the land itself and the strategic differences in how TPL and LB manage their physical assets.
And this is where the story gets really fascinating. It's the difference between legacy scale and operational efficiency. TPL has just immense scale, holding approximately 882,000 surface acres of real estate. That is an undeniable, irreplicable asset base, no question. However, this land is often in a fragmented checkerboard pattern. It's a consequence of its 19th century land grant structure.
And you mentioned fragmentation creates commercial burdens. Let's use an analogy. If TPL's land is a checkerboard, why is that commercially inefficient for their partners?
Okay, so imagine a major operator, like a Pioneer or a Chevron, needs to lay a 50-mile pipeline, a water line, and a service road to a new drilling pad. If they have to cross TPL's land, and that land is scattered in these small, non-contiguous squares, they have to negotiate potentially dozens of separate agreements.
Wow.
Yeah, often with different royalty schedules or access terms, just to complete a single infrastructure run. This slows development way down, it introduces capital inefficiencies, and it drives up transaction costs. It's like trying to build an interstate highway across a patchwork quilt owned by 100 different landlords.
So while TPL owns the most dirt, it can't always offer the easiest path. Now contrast that with LB's mantra of highly contiguous acres.
Right. LB has focused its entire strategy on owning approximately 300,000 highly contiguous acres, all strategically concentrated within the Delaware Basin. Their goal is surface control and industrial optimization. By offering these large, unbroken tracts of land, they become a one-stop shop for infrastructure development. If an operator needs to lay that 50-mile pipeline, they negotiate with one entity, LandBridge.
One contract.
One contract. This centralization, it just drastically reduces commercial friction and speeds up development, which makes LB a preferred partner for the major energy companies.
And I imagine the deals they strike really reflect this preference for surface control.
Absolutely. Just look at their agreements. LB has secured a 10-year surface use agreement with Devon Energy, DVN, and a long-term lease with 1AOK for a new natural gas processing facility. These are long-duration, high-certainty contracts that monetize the contiguous surface, and they lock in stable fee revenue for a decade or more.
Which brings us to their acquisition strategies. They seem to diverge along exactly these same lines. TPL is out there buying commodity upside, while LB is buying operational control.
That's the perfect summation. TPL is aggressively focused on deepening its mineral rights exposure. They just closed a huge $474.1 million all-cash acquisition of approximately 17,306 NRA, that's net royalty acres, in the Midland Basin. That just closed in November 2025.
And NRA is basically a bet on future oil production, right?
It's a metric of future oil production potential, exactly. So TPL is buying future oil torque. They are betting on the commodity price.
And LB, even when they acquire land, their focus seems to stay on the surface.
Precisely. Look at the $250.2 million 1918 ranch acquisition they made in November 2025. It included 37,500 total acres. But here's the critical distinction. 22,000 of those acres were fee simple acres.
Fee simple, meaning they own it all, top to bottom.
They own both the surface and the mineral rights outright. It gives them total control over development, logistics, infrastructure placement, everything. The remaining acreage was a mix of leasehold and mineral classified, but the core strategic prize was that 22,000 contiguous acres for surface optimization. LB is acquiring land specifically to run a higher margin logistics and infrastructure business, not just to sit back and collect royalties.
You know, this shift in focus from oil royalties to surface logistics and these high margin fees, it says the perfect pivot for our next big theme, the AI revolution. If LB is positioned as the infrastructure developer and TPL is the mineral rights holder, how are they both positioning themselves to capture the next great market disruption data centers?
Well, they are both benefiting from the same fundamental and, frankly, unique energy equation you find in the Permian. The AI revolution requires a massive build-out of compute power, and that power needs reliable, cheap energy. And the Permian provides it in spades. Associated gas, that's the natural gas produced alongside oil, it's nearly tripled since 2018. But the infrastructure capacity to handle all that gas hasn't kept pace, and that's resulted in a dramatic surplus.
And that surplus leads to the infamous negative pricing at the Waha hub. Okay, that sounds crazy. How can energy have a negative price? Break that down for us.
It's simple: supply and demand gone haywire. When the pipelines are full, operators are sometimes forced to either shut in their wells or, more commonly, pay someone to take their associated gas so they can keep producing the highly valuable crude oil.
So they're literally paying to get rid of it.
Literally. In 2024, the Waha hub, which is the major pricing benchmark for Permian gas, saw negative pricing on 46% of trading days. Prices dropped as low as negative 6.41 cents per million BTU. So if you are a high-intensity computing customer, like a massive data center, accessing stranded gas that someone is actively paying you to take, well, that is the ultimate power cost advantage.
So the Permian, which used to be defined by its inability to handle its energy byproduct, is now becoming the ideal location for the next generation of power-hungry data centers. That's an incredible, kind of unexpected synergy. So how is LandBridge, with its contiguous land, capitalizing on this?
LB has articulated a very comprehensive, integrated approach they call the powered land strategy. And this is far more than just selling off parcels of land. It's about actively bundling land, water, and energy infrastructure into a single turnkey solution for these massive energy-intensive customers. They aren't just waiting for data center operators to show up. They are actively building the ecosystem for them.
Tell us more about the execution of that strategy. What tangible steps are they actually taking?
Well, they announced a strategic partnership with a leading vertically integrated public IPP, that's a power generation and solutions provider. This partnership is specifically designed to accelerate the development of scalable energy infrastructure, likely including the planning or even construction of CCGT plants, combined cycle gas turbine plants targeting energy-intensive customers. They are designing the physical pathways for power transmission right now, across their contiguous acreage.
That sounds ambitious. Is there any hard evidence that this strategy is moving beyond a press release and into committed revenue?
Absolutely. The commitment is cemented by a major tangible deal. LB has secured a 2,000-acre data center option agreement that's backed by an $8 million non-refundable deposit.
$8 million non-refundable. That's the key part.
That is the key. The non-refundable deposit demonstrates that a major player sees immediate committed monetization potential in LB's land and their strategy. An option agreement means that the customer has essentially paid LB for the right to buy or lease that massive tract of land in the future for a very specific high-power usage purpose. So yes, LB is monetizing its future non-traditional surface use today.
Okay, so LB is building the physical infrastructure highway and providing the cheap fuel source for this data center migration. What is TPL's distinct counter strategy? Because while they have vast land, that checkerboard pattern might make a large-scale power infrastructure rollout a lot more complex for them.
TPL's strategy focuses heavily on solving the other major problem for data centers in a desert environment: cooling water. Data centers require just colossal amounts of water for cooling their servers, and the Permian is, chronically water-stressed.
Right.
However, TPL is trying to transform a massive industry liability into a new asset. The drilling process generates an enormous amount of toxic byproduct, often over 4 barrels of toxic or produced water for every single barrel of oil extracted. And TPL is actively innovating in produced water desalination.
That's fascinating. So they're taking this mandatory waste product that costs E&P companies millions to dispose of, and they're attempting to turn it into the necessary input fresh cooling water for the high-tech industry.
Exactly. If TPL can successfully commercialize and scale produced water desalination, creating industrial-grade cooling water from what is essentially a toxic waste stream, they instantly create a proprietary, non-commodity resource that addresses a fundamental need for data centers. It positions TPL not as a seller of land, but as a critical supplier of purified industrial water. It's a huge, long-term bet on water scarcity and industrial reuse in the desert.
So both companies clearly recognize the AI opportunity. But LB is betting on power and logistics access via its contiguous land, while TPL is betting on transforming the water supply chain through proprietary technology. That contrast brings us right to the core financial structures that are supporting these diverging strategies: risk, capital allocation, and flexibility. When we pick it back to the balance sheets, TPL presents this classic picture of financial conservatism that almost defies gravity in the energy sector.
TPL is a financial fortress. Their whole position is defined by maximizing capital optionality and eliminating market risk. As of early November 2025, TPL holds zero debt. Full stop.
Wait, zero, as in literally no debt at all. In an industry that's defined by leverage, that's an extraordinary strategic position. Why is that so crucial to their investment thesis?
It allows them to absorb maximum commodity price volatility without any fear of liquidity crises or, debt covenants. If oil prices crash to $30 a barrel, TPL is completely safe. That zero leverage profile, combined with their significant liquidity, they had over $531 million in cash as of September 30, 2025. It just gives them unparalleled flexibility. They also maintain a readily available, low-risk, $500 million undrawn credit facility. They don't even need the cash, but they keep the line of credit open for strategic opportunities.
Couldn't an investor argue, though, that zero debt means they're leaving money on the table, that they're missing opportunities for growth by not leveraging their massive asset base? I mean, couldn't TPL simply buy its way into LB's infrastructure game faster than LB can build it, especially during a market downturn?
That's the classic counter-argument, right? Against extreme financial caution. But TPL's capital deployment strategy balances that caution with growth. They focus on returning funds to stockholders through dividends or repurchases, but they also execute these strategic, all-cash acquisitions, like that recent $474.1 million mineral rights deal. TPL is buying future upside entirely with its own internal cash flow, which maintains its safety profile. They choose low-risk, pure-play commodity exposure, maximizing shareholder returns while retaining the ultimate balance sheet strength.
Okay, now let's contrast that extreme caution with LandBridge. LB is pursuing a high-growth, high-acquisition strategy that, well, it necessitates taking on leverage. How does their balance sheet support this aggressive surface monetization model?
LB's approach is fundamentally different. They are leveraging their stable, high-margin revenue stream to finance rapid strategic expansion. They use the debt as a tool to acquire contiguous, high-quality surface acreage quickly because time is of the essence if you want to capture this infrastructure boom. The 1918 ranch acquisition, which was critical for their contiguous surface control, that was partially funded by drawing the full $200.0 million delayed draw term loan facility, along with a draw on their revolving credit facility.
What's the significance of that delayed draw term loan structure in this context?
A DDTL is structured specifically for M&A. It allows the borrower, in this case LB, to secure a massive pool of capital and then draw it down only as needed to close specific acquisitions. This ensures capital is available immediately when a strategic land opportunity comes up, but they aren't paying interest on the full amount until the funds are actually deployed.
So it's very efficient acquisition financing.
Highly efficient. And crucially, LB expects this debt-fueled growth to generate a quick return. The 1918 ranch acquisition alone is projected to generate $20 million in EBITDA in 2026. So the leverage is justified by the immediate earnings power of the asset they just bought.
So LB is deliberately using debt to accelerate its path to becoming the dominant infrastructure provider, betting that their stable 91% fixed fee revenue stream can easily service that debt. Beyond the balance sheet, LB also possesses a structural advantage that is entirely unique: their control over strategic pore space. Explain what this geological moat is and why it provides resilience against macro challenges that maybe even TPL cannot match.
This is perhaps the most powerful non-commodity structural advantage that LB holds. Pore space refers to the deep underground geological formations where these massive amounts of produced water must be injected for final disposal. This disposal is not optional, it is mandatory, and it's governed by strict regulation. LB focuses heavily on owning and optimizing this critical disposal capacity.
So it's not just about owning the surface, it's about controlling the capacity beneath the surface to hold the billions of gallons of wastewater produced by the entire basin. Why is this becoming such a source of scarcity?
Because that disposal capacity is finite, and it's being stressed. Regulation is tightening, especially near state lines, due to rising seismicity and increasing pressure within these subterranean formations. Once pore pressure limits are reached, the injection capacity has to be restricted.
So LB's strategic focus provides a deep moat that is, geologically resilient against these macro challenges.
Exactly, and the problem for the broader industry is just looming large. Market forecasts indicate that rival regions to the Permian could face a catastrophic $9 million barrels per day disposal shortfall by 2035 because of these regulatory limits and rising state line pore pressure. By aggressively controlling contiguous land with strategic pore space and operating the necessary disposal infrastructure, LB is positioning itself as an irreplaceable bottleneck. This creates a long-term, structurally supported revenue stream completely independent of commodity price fluctuations. In fact, the more regulation restricts disposal elsewhere, the more valuable LB's proprietary capacity becomes. It is scarcity engineering at its finest.
This comparison is unlike any other in the energy space. You have two world-class Permian land plays, but they represent almost opposite investment profiles: a pure commodity hedge versus a diversified infrastructure play. We've detailed the financials, the strategies, the structural advantages, and the approach to the massive AI opportunity. So now, the final crucial question: does TPL's extreme financial safety and its mineral wealth outweigh LB's superior fixed-fee structure and its aggressive infrastructure play for the future industrialization of the Permian? Let's bring this thesis home.
The final verdict really requires the investor to assess their risk tolerance and their time horizon very, very carefully. For investors who are prioritizing irreplicable mineral rights, legacy scale, and who just demand extreme financial caution, well, TPL remains the quintessential choice. It offers a zero-debt balance sheet, and it is the best pure hedged call option on future commodity upside. If your primary investment thesis centers on the cyclical nature of energy, and you expect that oil prices will reward a financially untouchable entity over the next decade, TPL is your fortress. You're betting on the long-term passive value of mineral rights.
Okay, so TPL is the safe legacy commodity play. But conversely, for the investor whose time horizon is focused on the next phase of industrialization, the rapid build-out of data centers, the necessity of solving water logistics, the need for stable high-margin fee revenue, the conclusion seems to point toward LandBridge.
Absolutely. LB is the superior bet for capturing the future of West Texas industrialization. Its 91% fixed fee revenue is structurally higher quality, it's less volatile, and it's designed for predictable, high-margin compounding growth. Their strategically accumulated contiguous land positions them perfectly for the powered land strategy bundling access for power, water, and digital infrastructure. And most critically, their proprietary, resilient pore space asset provides a growth runway that's driven by the non-negotiable scarcity of water disposal and the burgeoning demand from AI data centers. This is an infrastructure as a service play that TPL, despite its size, it just cannot easily replicate due to its dispersed operational structure and its mineral-first mandate. LB is transitioning from a landowner to a critical, integrated infrastructure provider for the digital age, with a balance sheet that is tailored for growth.
So there we have it. The mineral giant, focused on maintaining its fortress-like stability and commodity upside, versus the surface baron, aggressively leveraging its high-quality surface assets to capture the high-margin, stable, and exponentially growing needs of the AI and infrastructure revolution. It's an evolution story versus a legacy story, playing out simultaneously in the hottest energy basin on the planet. For you, the listener, the choice is clear. Are you betting on the intrinsic value of the oil beneath the ground or the absolute necessity of the infrastructure that's built above it?
Risk defined, portfolio protected.